My name is Dhulipala. Phil basically talked about our fund. I'm a co-founder of Newform Liquid Capital Management. We are a fund of funds. Phil already headed a panel that talked about the market neutral strategy. The two talks that I have will focus more on the liquid token strategy where, while Bitcoin dominance has been increasing, I would say that a lot of the managers that we have, including really the gentleman sitting to my left, do generate a lot of alpha from asset selection, getting ahead of narratives, sizing their portfolios, and more importantly, and I think we'll have some time to get into this, is what are the next narratives that are driving the markets and where the value is coming from. So without further ado, I'm super excited to be talking to Ben Forman. I've known him now. We are an LP in his fund. I've known you for about 3 years now. I find the work that his firm does, a lot of the podcasts that he does, to be extremely thoughtful and insightful. And I'm super excited to kind of have a conversation with you about just the opportunities out there. So before we get into it, can you just kind of talk to us about your background and just the origin story of ParaFi and where you guys are at?
Yeah, well, thanks for having me here. So my name is Ben Forman. I spent the first 10 years of my career in traditional investing. I was at KKR and TPG doing private equity. And I was living in San Francisco in 2015, and through a friend, I had lunch at the cafeteria of Coinbase, which was a Series B company at the time. And that was kind of an eye-opening event for me because I learned about Bitcoin. Actually, back then, there was only one asset you could trade on Coinbase. It was Bitcoin. Then they added ETH. Then they added Litecoin. So in the first 6 years, they had 3 total assets. I think today Coinbase has 350 different assets listed on their platform. But back then, the world was a lot more simple. But I found it fascinating coming from traditional finance that you could take a complex legal agreement, whether it's a bond indenture, or a credit agreement, or a purchase agreement, or an insurance contract, and you could distill that legalese into code using smart contracts. So Ethereum launched in 2015, and it was much more expressive than Bitcoin. Bitcoin was inert. It was really more of a unit of account, but Ethereum was this programmable platform, and that really captured my imagination. I ended up leaving to start my firm ParaFi in 2018. So it's been 7 years, which in crypto it's dog years, it's forever. So it's almost a miracle that we're even here. But today we're one of the largest global investors broadly across digital assets and the blockchain capital markets. We manage about $2.5 billion of AUM across venture, both in tokens and companies, liquid markets, non-directional strategies, as well as public market opportunities in the crypto space. And we have a team that executes on that opportunity set globally. And where I'm really interested is, look, there's a lot of different things going on in the blockchain space, from gaming to the metaverse to intersection of crypto and AI. But I think the area where you're seeing the most product market fit are financial services. So financial services are 7-8% of global GDP, but finance really hasn't improved much in the last 20, 30 years. We have the internet and it's transformed everything. I can pick up my phone and order a hamburger and it will get delivered here in a few minutes. But it's still really expensive to send money, to get a mortgage, to understand the financial system, to access financial products. And by the way, it's the easiest for the people in this room if you're living in the US. But if you're living in an emerging market, good luck. It really has not improved. And so I think this technology has the potential to absolutely transform financial services. Capital markets, payments, insurance, debt financing. These are areas that just have not evolved. SWIFT was coded in the 1970s and 80s. Most of the securities laws that govern the financial system were written in the 30s and 40s. So this is really where we're focused, is on this intersection between traditional capital markets and blockchains.
Thank you. This is one of the slides that's in our deck, and it's a copy, it's a lift from a A16Z post about just the scope and scale of the payments industry. I know we had a conversation about stablecoins, but I just wanted to put some numbers into context. And I know, Ben, that you guys have done some really good work. I think these statistics tend to be overinflated. Like there are certainly very, very good payment systems that exist now and will continue to exist. So as you look at something like this, how does a Ben Forman look at the total TAM? What is the addressable market for payments? And where do you think we are currently? And how much of that pie has been kind of is being used by stablecoins, and where are we going?
Yeah. So maybe just before I dig into the numbers here, I think if you zoom out, the most popular consumer product in the world is the US dollar. The US dollar is used in 70% of global commerce. Everyone in this room is a user of the dollar. And if you think about kind of fundamentally stablecoins, so stablecoins covered really thoroughly in the last panel, all it is it's a dollar put in the file format of a token. By putting a dollar in the format of a token, it allows it to move more easily and seamlessly on the rails of the internet. And I really think about stablecoins, by the way, as almost it's almost the 0 to 1 moment for crypto. It's what ChatGPT was to AI, stablecoins are to crypto. What the Netscape browser was to the internet, stablecoins are to crypto. It's a technology that actually, it's an application that really shows you how useful kind of the underlying blockchain technology is. It's taken 16 years to get to the Genius Act. But even before we had the Genius Act, stablecoins grew to a $250 billion market. So actually, before I get into this data, just to ground you with how big this market is today, stablecoins are a $260 billion market. That market has grown about 60% year over year. There are 150 million wallets that have a stablecoin balance. And about 40 million wallets every month transact with stablecoins. If you look at that 40 million per month, monthly active users of stablecoins, that number has grown every year for the past 6 years. So regardless of crypto's boom and busts and FTX and so on and so forth, this is a secular trend. It's not a cyclical one. Okay, so why are stablecoins so useful? So if you think about the legacy payment rails, there are different types of transactions, right? There are domestic payments, there are cross-border payments, there's B2B, there's B2C, there's a whole host of different payments. But fundamentally, I can kind of just zoom out and say a stablecoin transfer allows you to move a dollar basically instantly, basically for free, peer-to-peer, without permission, and with a full kind of proof of authenticity and time-stamped track record. This is very useful in a variety of different applications. I'll start with B2B payments. So if you're a business and you're sending money, you're in the US and you're sending money to a business in Bangladesh, the average international remittance goes through 2.6 correspondent banks, takes between 3 and 7 days to settle, and oftentimes wires get lost. There's KYC requirements. It's very difficult to do. So that's one use case. If you're a business and you're paying employees in different countries, so B2C, SpaceX is a great example. They have employees and contractors in over 120 different countries. They use Bridge, which is a stablecoin product acquired by Stripe, which allows the CFO of SpaceX basically to push out dollar-denominated payments to its employees in all these different countries without actually even touching stablecoins. If those employees in those countries want to off-ramp into their local currency, if it's a Vietnamese dong or Nigerian naira, they can do that as a last leg, but many of them just want to hold dollars. if you are a merchant that's selling goods on the internet, for every $100 of goods you sell, you actually only get $98-ish from the credit card company. This is due to things like interchange fees and chargeback risk. The beauty of stablecoins is they're effectively a debit instrument. If you're spending a stablecoin, you by definition have the money. And so this, most of interchange fees and most of the VIG that you see in the transaction fee column is largely a function of, you have to pay the merchant acquirer, there are interchange fees, those go to reimburse the bank for potential fraud checks and chargeback risk. A lot of that can just go away. And then lastly, there's a working capital improvement here. So if you're selling goods online, or if you're selling goods, you may not get your money until T+1 or T+2. So this very much truncates the working capital cycle. So look, today, stablecoins are transacting about $25 trillion a year on chain. This number's also been growing at a compounded annual growth rate of over 100% over kind of like a long range view. And some of that candidly is people trading crypto and settling trades using dollars. But as you strip out the different components of stablecoin volume, you can see the B2B segment growing meaningfully. You can see card-linked stablecoin payments are now over $1 billion a month. So this is people that if you have a Visa card, they basically debit your wallet and pull stablecoins out of your wallet and off-ramp them. So that market alone is growing. You can spend stablecoins anywhere that accepts Visa or MasterCard. Peer-to-peer remittance is also growing meaningfully. A lot of this is in emerging markets. A lot of this is happening with Tether. And then you had the Genius Act. Again, this was last week. That was July 18th, signed into law. This is a big bang moment because up until this point, there was, stablecoins were operating in this nebulous gray area. And we see it across our portfolio. I mean, the amount of activity that I think we're going to see in the next 6, 12, 24 months is going to dwarf anything we've previously seen.
Thank you. That's what I love talking about with you is there are so many numbers that get thrown out. So it's 25 trillion of stablecoin value that goes on blockchain rails yearly. And if you adjust it to take out, the crypto traders going back and forth, it's still a very meaningful number. I think Visa puts it at about 800 billion monthly. Or annually. It's still a very, very big number. I actually wanted to talk to you a little more along those similar lines about what happens to the legacy systems. How do you see going forward legacy systems like SWIFT, Visa, MasterCard, bank wires coexisting with stable coins? And is this going to be what are the systems that will coexist and what are the ones that will get disrupted out?
So, look, I think that many of the firms at Western Union or just legacy firms are kind of having their the moment of, are we Blockbuster? And, did Netflix just come along? And it can always be difficult when you're making big margins on a commodity-like service and you see this new technology come along that's definitively 10x better. Do you disrupt yourselves? Do you disrupt yourself and sacrifice near-term profits in order to secure your long-term future, or do you just let the ice cube melt and hope that this technology is slow-moving? It's always an interesting conversation in a boardroom. So look, I think there will be many of these companies that just wither on the vine. But I think there are others Visa, MasterCard, Robinhood, and others that are saying this is the future and we want to be there for it. So I think you're going to see a bifurcation. I mean, I can tell you, so there are 90,000 financial institutions in the world, banks, fintech companies, insurance companies, payment companies, and all the big ones that we chat with are, recognizing that this is the real deal. I mean, JP Morgan is tokenizing bank deposits. Fidelity has come out and said they're going to launch a stablecoin. Bank of America has said they're going to launch a stablecoin once we get regulation, and we just did. The big fintech companies like Adyen, Nubank, Revolut, I mean, everyone is focused on this area. They won't all launch their own stablecoins, but they will all use stablecoins as part of their business model. So that's the simple answer to your question, is it depends on the company and whether they want to adapt or die.
Yeah, and the way I look at it is, we both ran credit hedge funds. The back office, middle office is like a big money sink. And when you think about basically the payment systems of these banks, that's a lot of back office. And I think, so I don't really think of it as a competition as much as it is actually a real benefit to the banks to use stable coins as a medium of payments, which basically disintermediates their own costs.
Yeah, so if you look at employment at banks, there are two areas at banks that have grown in terms of headcount. Back office and compliance. Mm-hmm. So settling trades, like the cost of settling a trade, there was an interesting study done recently that showed that the human inputs and the technology cost to settle a simple transaction has grown at a 14% compounded growth rate for the past decade. And something like around 5 or 7% of trades are not reconciled correctly, and you have to go back. So it seems like it's something we take for granted, right? Because we don't necessarily see what happens under the hood, but it's a big source of cost for these financial institutions. So this is an opportunity to increase margins.
I know I'm going to geek out, but we both traded loans, so for a fact that
it's
they always
T+20
fail.
Settlement.
T plus 27, half of them fail. Yeah. By the way, this is the one question I really did want to ask you, and this is why I'm excited. So I was listening to a podcast, and I've listened to a few of your podcasts, and this was a A16Z podcast with Chris Dixon. And his statement was actually pretty thoughtful. He said, the most obvious investment opportunity right now is stablecoins. I mean, the scope and scale is massive. But having said that, it's extremely difficult to figure out where the value actually accrues. Because, stablecoins are supposed to disrupt the way businesses, they're supposed to take margins down. So in a classical, kind of investor world, how do you foresee where the value accrues? And I'll lead it up a little bit, and you might disagree with me. He kind of further went on to say that maybe the value accrues to some of these layer ones and layer twos that handle a lot of the traffic. So how does a ParaFi look at this opportunity, and how are you guys trying to monetize from this increase in stablecoin volumes?
So I think that's the most critical question that an investor in the crypto space can ask is, if stablecoins go from 260 billion to 2.5 trillion, which is what the BIS estimates will take place by 2028. So if you get 10x growth in stablecoins moving on chain, what accrues value? I think largely there are kind of 4 categories. One are the blockchains themselves. So right now, roughly 30 to 40% of ETH gas is associated with stablecoin transfers. So every time you move a stablecoin on a blockchain, it's not free, right? You have to attach a fee to that transaction, and that accrues to the underlying layer 1 or layer 2 token holders. And the value accrual mechanism will vary depending on the blockchain. But that is ostensibly one area you could look. The second is DeFi. So once you have stablecoins on chain, there's a simple send receive function, right? But what about earning yield with them? What about posting them as collateral? What about buying an insurance premium with them, and all the things you can do with dollars from a financial standpoint? So we think about DeFi today. There's roughly 50 to 75 billion of TVL in DeFi protocols on chain. What happens when that stablecoin market 10x's? The fees that accrue to all these DeFi platforms, whether it's Curve or Uniswap or Aave, ostensibly will also go up. And so they're large beneficiaries. And then the third bucket are the issuers. So companies Tether did more profit last year than BlackRock It did more profit last year than Goldman Sachs. They have 120 employees. There's 260 billion of stablecoins on chain earning short-term yields of, say, 4%. So you can run the math. That's like over $10 billion a year of basically like gross revenue. And that number, if stablecoins 10x, that 10 billion would go to 100 billion. Now, the tricky thing about investing in the issuers is right now there's a duopoly between Tether and Circle, right? They're about 230 of the 260 billion of stablecoins. But with the Genius Act passing and other banks entering into the stablecoin arms race, understanding what market share will look like down the road is tricky. Also understanding where interest rates go. If interest rates move lower, stablecoin issuers will earn less of a spread. So there are a number of different dynamics there, but that is another place that value will accrue. And then the last component is just all the picks and the shovels. So, companies like Bridge and Privy were sold to Stripe has made $2 billion plus acquisitions in the stablecoin space in the last 3 months. I think there will be many more companies that build front ends, compliance software, solutions for institutions to use and interact with stablecoins. And those companies are critical because, look, at the end of the day, using blockchains is not actually like very easy. It's very, the user experience is kind of messy. And that's why if you look at actual retail usage of blockchains, it's plateaued. Like if you look at the number of individual wallets, like it's actually not growing that quickly. But the value on chain is growing disproportionately because the users are more fundamentally businesses and financial institutions moving larger dollars. So these businesses like don't want to deal with gas fees or priority fees or understanding the complexity of using blockchains. They just want like a simple interface that abstracts away that complexity. And so there are lots of great software companies that I think will get built this cycle that do that.
No, thank you for that. Can you just talk about, we're talking about 260 billion going 10x in the next 4 years or 3 years. Can you talk to the scalability, like how much, do the current layer 1, layer 2 combos and just layer 1s, can they handle it? What does, inoperability or operability look like going forward? Can you just talk to latency, bottlenecks, and technical issues that you guys are potentially thinking about?
Yeah, so scalability of blockchains used to be a big issue. Like in 2020 and 2021, there was a scarcity of block space. And there were a lot of people that wanted to use blockchains to do things on a relative basis. Now there's it's like the infrastructure build out in China. There are ghost cities of blockchains that no one's using. There's plenty of block space. That's not an issue today. Maybe if stablecoin volumes 1,000x from where they are today, maybe then there's a conversation, but I still don't even see it because there's just there are way more layer 1s and layer 2s than feels like we practically will ever need. But let's check back in a few years.
All right, sounds good. So this is where, by the way, this conversation is going to go completely off stable coins.
Okay.
As I said, we are LPs of Ben, and we've been getting the letters, and I think it's very appropriate to kind of talk about digital asset treasuries. You guys have obviously been, I'll be brutally honest with you. When I first looked at it, I was like, this is nonsense. Why am I paying $2 for an asset that's worth $1? And I would have probably continued to think along those lines till kind of I read some of the work and some of the paper, some of the stuff that you guys have published. So can I just ask you about, before we, just very, very quickly, because we have about 6 minutes, what are digital asset treasury companies? How many have come on board? How much is in the pipeline? And why is it that, I'm paying $2 for, a treasury that has $1 of Bitcoin or ETH or Solana or whatever?
Yeah.
Over to you.
Wait, can we just take a quick poll? How many people think that digital asset treasuries are total, BS?
Be brave.
Right? Like, okay. Okay, yeah, I was expecting more hands to be up. But so a digital asset treasury. So what is a digital asset treasury? So digital asset treasury is this new kind of category of public companies that their business model is they, basically buy Bitcoin or Ethereum or Solana or a digital asset. They simply just buy the asset and try to accumulate as much of the asset as they possibly can. So what's the background here? So a company called MicroStrategy, I'm sure you guys have all heard of it. In 2018, it was a failing software company. The CEO, Michael Saylor, said, hey, I want to just start buying Bitcoin. I don't believe in the fiat system. So he started issuing convertible debt and selling his stock in an at-the-money equity offering to accumulate Bitcoin. Today, MicroStrategy owns 3% of all Bitcoin in circulation and has, on a given day, is a top 10 most liquid and traded stock in the US public markets. So this has attracted many, many copycats. Today, there are about 150 companies globally that have announced digital asset treasury strategies. These are, mostly focused on Bitcoin, Ethereum, and Solana. Fundamentally, like what these companies are doing, and most of these companies that have announced these strategies have nothing to lose. They typically had like a failing business, or they have a shell company public that they said, well, we're not doing anything else. Like, let's do this because the market seems to be rewarding it. So what's interesting is, so when I first saw MicroStrategy in 2018, 2019, I had the same reaction that you did, which is like, why would I ever pay a premium for Bitcoin? I can just buy Bitcoin in spot markets. I'm like, okay, maybe it's because people can't access Bitcoin in spot markets. They have their brokerage account. They just want to buy something that looks and feels like Bitcoin. Maybe they don't want to pay a premium for GBTC. But then when the Bitcoin spot ETFs were approved in January 2024, the premium just continued to exist and persist. If anything, it widened. And so that kind of piqued my antenna, and I kind of like started to dig in. And fundamentally, what this company is doing is it is able to effectively arbitrage its own stock to accumulate more Bitcoin per share. So what does this mean? The kind of stated mission of MicroStrategy is to increase units of Bitcoin owned per share of common stock. They do this through selling their stock in the open markets through an at-the-money equity issuance at a premium, taking those proceeds and investing in Bitcoin. So effectively increasing units of Bitcoin per share of common stock. When their stock trades at a discount to NAV, they do the inverse. They can sell their Bitcoin and they can buy back their stock. So when they're above...
Hey, Ben, can I interrupt? Like, has that ever happened?
So MicroStrategy has traded below NAV, and instead of doing that, they issued converts and bought back their own stock. So that's the other thing that they do, is they issue convertible debt. So MicroStrategy is the largest issuer of convertible debt in the world. They're about 8 billion of the 250 billion convert market in the US. And what they're doing is, Bitcoin's volatile. So they're selling, so when you have a volatile underlying stock or underlying asset, you can, convert investors, love that. So they're basically issuing converts at 0% coupons and using those proceeds to buy Bitcoin. And they're issuing these converts 30 to 50% out of the money, so it's not as dilutive. And right now they're running at a very, very low, their loan to value ratio is like 15%. So, and there are no covenants on these converts. So like, they're not gonna be a forced seller. There's like this narrative in the market that, MicroStrategy is gonna have to fire sale all of its Bitcoin. But when you dig into the capital structure nuances, that's impossible. Unlikely to happen. Yeah. They're also using preferred equity instruments and all these other instruments to increase Bitcoin per share. As a result of this, you would have been better off owning MicroStrategy's common stock than you would be holding Bitcoin if you look back over the last 1, 3, 5 year periods. Because MicroStrategy has accumulated something on the course of, they've increased the units of Bitcoin per share by like 3x. So that's the essence of what's happening here. Now, how sustainable is it? I think that there's simple supply and demand. Like, look, like how much capital is there that wants to buy crypto? We're getting kicked off. Crypto treasuries at like, premium to NAV. I think eventually the cycle will turn, and there'll be consolidation, and there'll be M&A, and there'll be opportunities for investors to buy these at discounts to NAV. But look, just like anything, this market cycles. But what I think is interesting is even if these things trade below NAV, you can still sell Bitcoin and buy back your stock. So if you're a long-term holder and you believe in a management team's ability to use the Swiss Army knife of capital markets instruments to do that, then I think it's plausible to believe that this is a way to outperform spot.
Hey, I know our time's running short, but I would be remiss. I have to ask you about the statistics. Like, how many of the digital asset treasury companies bought Bitcoin? How much is in the pipeline? Like,
so there are like
Solana, just so that we understand what the market dynamics
there are like 10 to 20. So right now, I estimate that around like 3% of all U.S. public companies are crypto treasury companies, and that number is growing. I mean, there's like by the way, these investment banks are just making a killing on these deals. I mean, it's crazy. Like
as are you, by the way.
I mean, so we'll see how things end up. We'll see how, but the investment banks are just taking fees in cash. So, but it's remarkable, and I think that it'll be a really interesting next 6 months. There's a lot happening. So,
again, I thought we'd have time for Q&A, but but I also knew there was a lot to talk about. Ben, thank you so much.
Yeah,
it's always
you so
a
much.
pleasure.
Yes, this is a lot of fun. Thank you.